I've not seen a year like 2008.
Now it's official, we are in a recession.
I've not seen, like the global financial crisis, but does not mean that I can't learn from data.
If you were to just do overnight positions, you'll end up making 20% return. And if you were to just be invested in Nifty during the time it's trading, you'll end up making negative 8%.
What exactly does backtesting prove?
The saying that goes, right? Like history doesn't repeat itself, but it does rhyme.
We get to understand human behavior by that.
We don't know what's going to happen in the future, but we want to know what's the probability of making money.
If you could just give me a sense of how does Qode do backtesting?
We refrain ourselves from doing a backtest. We try to identify patterns, we try to identify regimes.
This pattern maybe existed in the past, but what's the underlying reason behind that?
There's so much trust issue, like people don't trust backtest.
The idea and the thought process behind backtesting is only using backtesting as a reference check.
I don't think, at this moment as I speak, there's a perfect strategy that exists.
Unless Claude comes out with something. Welcome back to Leverage by Qode, where quant thinkers take the mic and we decode the markets through a sharper lens. In the last episode, we explored how growth becomes too expensive, narrative-driven valuations create fragility. This episode is about backtesting, the single most seductive and most dangerous tool in quantitative investing. Every strategy that looks incredible on paper has been backtested. So welcome guys, and who better to discuss that than our fund managers Gaurav and Rishabh. Really excited for this conversation. And let's get started.
Yes, exciting topic, Pratik.
Thanks, Pratik.
So backtesting is often presented like the strategy works. What exactly does backtesting prove and what it can never prove?
So, I think the idea and the thought process behind backtesting is only using backtesting as a reference check. So, we don't know what's going to happen in the future, but we want to know, what's the probability of making money. So, what we end up doing is that looking at say 10, 15, 20, 30 years of data, whatever data is available, and looking at the environment, that sort of the data is built in, and then trying to model different scenarios as to, what works, what doesn't work in the environment, and then going ahead, seeing that what worked in the past, will it work in the future. So the idea is that you're just looking at like a reference check. So we don't look at the numbers very seriously. So if a backtest shows say a 25% CAGR, we don't extrapolate that into saying that, I'm going to make a 25% return. That sort of never happens. And when I say never, I literally mean never. The future is going to be really different. We've had instances where our backtest has shown say a 15-18% return, and live we are up 40%. So the numbers could be very different. It could turn the other way also. You could have a backtest which is up say 30% per annum, but then the future return is very different because of the environment changing. So when we are looking at backtesting, only looking at like a tool as a reference check and nothing more than that.
We have a saying in Qode as well, right? Like never trust the backtest because it never actually ends up doing what we've seen.
Yeah, absolutely, right? Like, so that the saying that goes, right? Like history doesn't repeat itself, but it does rhyme. So you're trying to figure out as to, okay, fine, are there going to be similar environments, and is there going to be a similar future? And if that is true, then how will the market behave?
Yeah. So I can add to this, Pratik. So I would say the reason for us to what the backtest does for us is we get to understand human behavior by that. Now, if I just give you an example, let's say Nifty does 12% return, over a long period of time. Now, if I was to just break this data up and, ask you how much return does Nifty give overnight and how much return does Nifty give during the time that it's trading. Now, people would think maybe 80% of the returns are overnight and, maybe whatever that number is. But an interesting, stat over here is if you were to just do overnight positions, you'll end up making 20% return. And if you were to just, be invested in Nifty during the time it's trading, you'll end up making negative 8% return. Now, obviously, you can't, do this because, the transaction cost and, the exact price, you won't be able to get. But this tells us something about, behavior of when the maximum amount of change comes in the market. Now we can view it in any way we want to. Let's say if you're working on a particular strategy, maybe that can be a part of it. But a large part of our exercise, is just about understanding how a particular thing behaves or just how, investors are treating that particular instrument.
Very interesting. It also makes the case for staying invested so you don't miss those gap up days. So next question is, when we look at backtesting, what are the biases that come about when you are trying to go in the process and you're trying to backtest a particular strategy?
I think the the largest, if I were to talk about there are multiple biases, but if I were to just pick on one thing, I would say that curve fitting or say overfitting, is one big bias, that the backtest that you're running is good for that data set only, right? Because if you look at the market, it's a very complicated place. There are lots of factors that influence, where money is flowing. Say for example, as we speak, we're in a situation of war because of the market, because of which the markets are down say 15-20%. In fact, if you look at data for gold, if you look at like the last 20 years, there's never been a case where in 3 days gold is down say 20%. Right, but we saw that live. So, if you run a backtest on gold, you would be like, okay, this is a really safe instrument and volatility is low. But when you go live, had you gone live in Jan of 2026, you would have realized, it's a very volatile instrument. So the thing is that you need to understand that the limitation of a backtest is limited to the data set that you're looking at, and there's always a case of overfitting. And so what you need to sort of figure out there is that you want to find out that, okay, fine, what is the environment in that data set, and then you start taking decisions based on that. Just don't go on a backtest saying that, I did a 3-year backtest or a 5-year backtest and it's given me a 20% result, so I can move and go live with that strategy, because the environment is always going to change. The environment is not going to be the same. And so that's if I were to say in terms of bias, that's the biggest limitation or bias of backtesting.
Absolutely. I think one more thing I would like to add here is in terms of biases. Now, survivorship bias is a big one also. Let's say if you were trying to understand what sort of companies have done well in the past, what generally people tend to do is get the entire stock list as of today and then test it for the past 15-20 years, saying what changed, did the earnings go up, was the working capital better, whatever that was, you'll get a particular answer. But the data set, in terms of number of companies 10 years back was different, 20 years back was different. So you'll never get a true picture. You'll only see the survivors, that are there today. It's possible that, historically there was a, company that had tremendous revenue growth, but maybe the cash flows didn't increase and, maybe the company had to shut down. But that company will not be a part of, this backtest. So the idea is to ensure that, let's say if you're running a test for, let's say 2005, 2010, the data that you have is, as if you were live in 2005 or 2010 and you're looking at that same data set today. Only then will you get a true picture.
So survivorship bias free data is sort of like, see, these problems happen at the beginner level, but as you sort of do multiple backtests, I think like this will start, this is becoming an important factor. Though a lot of people don't understand this factor, it becomes an important factor, and rightly said by Gaurav that like, it seems very insignificant, but it will change the numbers drastically.
So when it comes to, let's say, survivorship bias or look ahead bias or future leak, as we call it, they can be still, fixed, right? You fix your data set or you fix your backtest. But things like, as you mentioned, overfitting and curve fitting, that seems to be like a real problem even in the professionals. How do they, avoid the pitfall of just selecting the best factor and then, curve fit their entire model or like skew that? How do you actually solve the problem of overfitting in your models?
So, see, you'll never be able to 100% solve that problem. That problem will remain. You can only reduce the impact of that problem. What you could do, so say for example, if you're looking at a long only backtest for India, you're looking at say 2001 to 2025. Now the thing is that we've only seen a bull market, right? We've seen a structural trend out there. So any long only system will have a positive return. As long as transaction costs are low, even like a silly buy and hold or churning your portfolio once a year, well, it's going to have a positive outcome. So now you need to understand that, listen, we've been in this environment where there has been structural growth and this environment will remain. So this element of, curve fitting is going to remain. Now, what you can do over here to sort of, figure out or remove that element of curve fitting is label the environment. Figure out, okay, fine, we've been in this, we've been in this zone. I should not limit my backtest to India. I should also look at other countries. So say, for example, if I were to run the same backtest in something like a Japan, they've had a very different environment, so the result has been very different. Going forward, you need to understand has the environment changed or is the environment the same. If you can figure out this problem, it's a complicated problem. It cannot be done only by a simple backtest. If you think that you run a backtest and you'll identify the problem, it's not going to be that simple. You'll have to study history, you'll have to study patterns, you'll have to subjectively study and then create a system out of it. So if you can do that by looking at also other countries, then you can sort of remove that survivorship bias element or the curve fitting element. So the survivorship bias problem can be solved by changing the data set, but the curve fitting problem requires a lot more work and understanding of the market as a whole and looking at years of data across countries and across cycles.
Absolutely. One thing to add over here is, whenever you're running a backtest, you need to understand, first principles. Now, for example, it's possible the last 20 years I ran a backtest on just where the price is, let's say based on a moving average or something like that. What I need to understand is this pattern maybe existed, in the past, but like what's the underlying reason behind that? A first principle example could be, if earnings of a particular company grow, my stock price will grow at that point in time. Now let's say you ran the back test, you let's say got a 25% return over period of time. The question is, did earnings grow over that same period, or is it just liquidity driven? Is it just more capital flowing into the same company where the earnings have not grown and the multiple of that company has increased? Maybe it's possible that the back test was successful, maybe the returns were real, but then the question is this pattern repeatable? If you can't come to that conclusion that this pattern is repeatable, then it's not a good back test. Let's say if you were to run the same thing on earnings, let's say if you picked 5 factors, fundamental factors, and then ran your back test, and then you realize that the earnings growth that you see in these companies is, let's say, 20 or 25% or whatever that number is. The first principles say that if the earnings of the company is growing, my stock price will grow also. So as long as that remains true, we know that there's going to be a resultant effect on the stock price. So that is what we try and capture. Make sure that the underlying reason, the rationale for doing it makes sense.
Perfect. So the real kicker is to understand the driver, and then that makes your model more reliable.
Correct.
Got it. So you just mentioned that we need to look at other markets and international markets, because if you look at Indian data, right, I think we have clean data that we can rely on back till 2005. So we have a roughly 20-year data. So how exactly should one go about backtesting and making it more robust from a testing point of view? Like US markets, we have a lot more data, but how would you approach that?
So you go step by step, right? You start with, say, India data. You'll start understanding, if this is the first time you're doing this, first you'll go through all these iterations where cleaning the data, survivorship bias, prices, backtesting, all these things will come into picture. Once you've crossed that bridge, that is the first part of the problem that you're solving. Now, say you even come up with a successful backtest based on certain result. You need to understand why that works in India. What is the cause and effect? Like, Gaurav rightly said that, like, earnings growth, or is it PE expansion? What is the reason for that kind of a result? Then you move back to see, okay, fine, what is the macro environment during this entire backtest period? And there could be multiple environments also. So you got to pick and choose and understand that, okay, fine, you go basically take a deep dive into that data. So you understand, okay, fine, where were the years of outperformance, where were the years of underperformance, do I have down capture, up capture, etc., looking at multiple ratios. Then you move to the next step wherein you're looking at, okay, fine, how would the same strategy perform in a different market? And you would start realizing that, oh, like, it's performed really badly in another market. And you need to understand why it's performed badly, because if that same environment comes up in our market, at least you will know the reason for the underperformance. So the idea over here is that, you take it slow. Don't make backtesting a very fast process. So, Pratik, if you can write a code, using an AI model, don't just think that, okay, fine, I wrote a code, I did a backtest and I got a result, right? Slow down the entire process. Go into every trade that's been taken, go into every month, look at the result, look at how the stock has moved, look at how the portfolio has moved, compare it to an index, then move to the next step wherein you're comparing the entire data set or the backtest to another country. See how this model would have performed in another country, and you will definitely see, like, very different results. You'll see that, okay, fine, here it's actually underperformed, and you need to understand and question that, okay, fine, why it is. The reason why getting into the cause and effect relationship is important is because when the model breaks or when it doesn't do well, you'll not even know why it's not doing well. But if you know when the performance is good, the reason for the outperformance, it'll be very easy for you to understand, okay, fine, for these reasons, there is some underperformance.
I just like to add something over here. Now, a very popular metric that people end up looking at, let's say gold to Nifty ratio, or gold to any other index ratio. Whenever that ratio is high, that means you need to buy the index. Whenever that ratio is low, you need to buy gold. Now, a fundamental problem with that is over the last 15 years, let's say if you're looking at small cap or mid cap index, that has grown at 15 to 16%, as compared to gold that has grown at 10 to 11%. Today, whenever you're looking at that ratio, you'll see that the index is always high, which means that you should be taking an exposure in gold. But fundamentally, that does not make sense. Obviously, equities will grow at a faster pace, as compared to gold. Gold might add the stabilization to your returns and all of that, but it's fundamentally it has grown at a slower pace as compared to equities. Looking at that ratio today, you can't derive the same thing that you could derive 20 years back, or let's say even 15 years back. So understanding that things have changed, we are not in the same situation that we were historically. If you were just to run a backtest, you will see great results. You will see that, hey, this model exactly tells me when to be in gold, when to be in equities. But the time now has changed. It's not the same as it was before, and it's very important for you to understand the nuances of it, rather than blindly accepting the results of that backtest.
Yeah, that really makes sense. Now, talking from a point of view, anyone in the quant space, the excitement you get when you see a backtest and you see like a really good result, you feel like the job is done, right? But what really separates a robust backtest from a misleading one? What are the characteristics?
See, generally, look at what Galimanga says, right? Like, show me the incentive, I'll show you the outcome. If you're just an analyst and, you're just enjoying the backtesting process and you're not thinking about capital deployment for whatever reason, right? Like, either you have the money, you don't have the money. I think that's where the big gap happens, right? When you're purely thinking that I want to make money, I'm a capitalist and I want to figure out anyway, whether it is subjective, objective, quant, not quant, I want to figure out a way to grow my wealth, right? I think that's where you get into deeper thinking, deeper knowledge. That's where you question the backtest. So I think so. You need to understand when you're doing the backtest. Are you doing it from a theoretical perspective that I'm having fun and I'm doing some work, or is it with a pure intention that listen, I want to figure out a way to predict what's going to happen in the future and I have money to deploy. If you're going to do it with that perspective, then even if it's an average backtest, I know that you're going to think of every situation because there's going to be skin in the game. There's going to be risk involved. So that sort of will define like a good quant analyst from a bad quant analyst. It's all about intent and thought process out there.
So, one practical example over here in terms of a backtest, and this is, done in any statistical, study, or let's say, machine learning exercise that you're there. A lot of people, let's say we are sitting in 2026 today, a lot of people run a model from 2000 or 2005 till today and see this is going to, this has worked in the past, as now this is going to work in the future. A very important concept over here is, out of sample, modeling. For example, does your model work for out sample? I'll explain to you how that works. Let's say, if you were to not test the data from 2000 to 2025, you test that data for, let's say, 3 or 4 year period from 2000 to 2004, and then study that did this work for me over the next 4-5 years. Then you take another 4-5 years of data. Then you study, did it work for me for the next, 3 to 4 years. Similarly, you keep repeating that process. Similarly, you take different in sample period, out sample period. You end up taking different regimes, into consideration. Maybe end up taking an entire cycle, from bull to bear to bull, and then keep repeating that particular process. Every model that gets made, it could be an extremely curve-fitted model. If you look at that, data today and then just run that backtest for the last, 20-25 years and assume that's, going to be true. That's not how it works. There are multiple models that we have made that, last 25 years, we look at that data. There's a metric called R square. We look at it and, it'll show a great result. And then when we break it down data into 3 year, 4 year, 5 year periods, the result is not as great, which tells us that, out of sample is, not giving the same result as compared to the in sample data that we have.
Yeah, so now if we talk about another nuanced concept when it comes to backtesting is transaction costs, which seem like really small, but when you look at it in aggregate, how much of the real returns can be taken away from this particular thing if not done correctly?
See, this is a simple question, right? I think like transaction costs start affecting you a lot depending on the holding period of your position, right? So if the average holding period is say a year, transaction is 1 year or 2 years or 3 years, then transaction cost is going to be insignificant, right? Even if you're paying a heavy transaction cost, doesn't matter. But if you're going to churn your portfolio once a day, then transaction cost is everything and it can make or break your system. generally when we judge a system, we look at this, we look at this metric called trading edge, and the trading edge essentially is, the formula is your winners into your average win, losers into your average loss. And when you get that final number, the higher the number, the better it is. So for example, just for reference check, if you look at like a 1-2 year holding period, your trading edge will be like 10%, 12%, 13%. Now if you add a 0.5% transaction cost, it is not going to change your backtest significantly. But the moment you're coming to smaller trades, where say for example something as small as scalping, where you're getting in and out of a trade, right? So you're going to make really small bucks on the transaction. You're going to make like 0.1%, 0.2%. Now transaction cost really starts eating in over here, so it becomes even more important to involve transaction cost. So if you're looking from a robustness perspective, transaction costs are very material when looking at shorter time periods, but they become immaterial when you're looking at extremely long time periods. And a lot of times people fail to sort of take this concept seriously, because like what Gaurav mentioned in the first answer, that if you look at Nifty overnight returns are great, but the moment you take into consideration transaction cost and STT and other charges, those returns fade away. So this concept is important to understand.
Just to add another technicality to this is, so when you're looking at transaction cost, a lot of people within their model tend to capture, let's say, the brokerage, the STT, the exchange fees, and all of those things. What is also important to do is try and understand what the impact cost is. For example, as Rishabh mentioned, in terms of time periods, you can also look at it in terms of trading frequency. So if your trading frequency is high, like a small impact cost over there ruins the entire system. And let's say if your trading frequency is again 1 year, 2 year, 3 years, then that impact cost does not affect the entire model. But very important to still consider the impact cost and run different variations on how much let's say the impact cost also varies with how much quantum of capital are you bringing to the table. So makes sense to study it at varying degrees to understand what my final impact will be.
Another sub question to that is that when we look at liquidity, or we look at being able to buy, so do you guys also look at volume data when you are doing backtesting to see how really you would be able to buy? Like for example, if you do just a micro cap backtest, the returns end up being really good, but would you be able to buy like a large portion on that at that price in your backtest? Probably not. So how do you solve that issue in your backtest?
So definitely, like, this is a problem that you need to account for, because if you're looking at large volumes in the like you said, the microcap space, you're not going to get that execution capability. So it's a ghost price. You mentioned that, oh, I need to buy this 100 crore market cap stock at say 200 rupees, but you're not going to get that price because there's no volume on the other side. So the backtest is absolutely redundant then. So taking into consideration volume is just like sort of like a best practice, or it's one of the check boxes while doing a testing, and it's sort of compulsory, right? Otherwise your backtest does not hold any validity.
Now that you've talked about small nuances that are there in backtesting, what to do, what not to do, if you could just give me a sense of how does Qode do backtesting, how different is it?
So I'll tell you from Qode's angle, everything is sort of what Gaurav mentioned earlier, first principles. It's not about the backtest, it's not about the result. We stopped looking at, like, initially in our early days we used to do this, where we would get really excited looking at a backtest result and, oh, it's done 30% or 35% or whatever absurd number. Now we sort of step back and see, we try to measure every backtest or every test in terms of first principle. In fact, we refrain ourselves from doing a backtest. We try to identify patterns, we try to identify regimes. For us, everything is first principles, everything is cause and effect relationship. Okay, fine. If earnings move, then how will the stock perform? If the stock is performing, is it because of earnings growth? Is it because of P multiple expansion? Everything, whether it's like a short-term backtest, a long-term backtest, everything is in terms of cause and effect relationship. See, once you are at an advanced stage of backtesting, you're not thinking about stuff like survivorship bias and overfitting and all these things, because you've already taken care of all these things. Like, these are things that you sort of take care in your early days of backtesting. Now, when you're in a case where you're managing larger sums of money, and you've already seen some sort of success, you're trying to get down to cause and effect, you're trying to get down to market regimes, you're trying to figure out, okay, fine, what is this going to hold valid for the next 5 years, the next 10 years? Because those are the tougher problems to solve. So those are the things that we are trying to solve today at Qode. That okay, fine, what kind of regime we are in. We are also trying to identify, okay, fine, today, in the situation of war, what's going to happen in the future. And we mentioned this a lot of times, that like Ray Dalio has done this successfully, right? Even last year, say, he was up like 24% when markets were flat or markets were down. Even as we speak, he's doing extremely well. But that's because of his ability to objectify everything, to study history, not only in objective terms, or not only in terms of price data, but also in terms of the kingdoms that have come and gone, the countries that have gone bust, and then looking at a much broader framework. So that's the thing that we are trying to solve right now.
So Pratik, I'll give you an example of some work that we have done in the past. Let's say if you just pick momentum as a factor. Now we have data that the last 100 years momentum has worked. Now if you just look at momentum, it's a price-based indicator that where the price is for a particular company, how it has moved. Only basis that you are buying and selling stocks. There's no underlying fundamental factor. There's nothing specific about the company sector. Nothing there. What we wanted to do with momentum is break it down into first principles. So, for example, let's say if you again coming back to India's economy. Let's say last 20 years, if you test momentum, you will see that you've gotten a 22-23% return over time. Now, if we have to understand how much of that comes from earnings growth and how much of that comes from PE expansion, we still see that a large amount comes from earnings growth. So our belief that a factor like momentum will continue to work, that is strong. We believe that this will continue to work, but there's still some element of PE expansion that happens in the companies that momentum invests in. Now we feel that over time keeps getting adjusted. It's possible that someone might be buying momentum today based on the historical study, not knowing what the underlying principle is, and they might end up inflating the stock price, but the market ends up correcting everything. So we feel that will come down over a period of time. Now let's say if we were to build a model that predicts stock price growth, if we get 80-90% of the growth from the earnings itself, we feel that the model is more robust as compared to some other model which only earnings growth ends up giving 50-60% from just the earnings growth. So that is also one factor. Try to break down the cause and effect, and then try and understand what is the primary returns generator and what could be a temporary returns generator.
So, if someone has to take away something, like an investor has to take away from this entire episode, what would you want him to think about backtesting? Because there's so much trust issue, like people don't trust backtest because of the reasons we've discussed over here. How should someone look at a backtest result, look at a quant strategy which bases its strategies on backtest, even if it's the last process in the entire framework? What would you say to that?
So I'll take that. I think when you're thinking of this problem, think of it as I'm referencing history. I'm trying to figure out what's happened in the past, not to rely on the result completely. So I think so, like, for example, we are a young team, and, say we have like, say, 6-7 years of experience. Now, or 8 years of experience. But the idea is that, like, I have not seen a year like 2008. I have not seen, like the global financial crisis. But does not mean that I can't learn from data. Just because I haven't experienced it doesn't mean that, like, I should falter if that happens again. Right? So the idea of looking at backtest and history is to sort of learn out of the experience of other people and take advantage that, okay, fine, the data is available to learn, rather than waiting for the day when you lose money and then you learn. Right, so that's the thought process and mindset with which you're going into backtesting.
So I, over time I've come across, people who understand, let's say, the backtest, and there are some not just a backtest but a quant framework. There are some people who don't understand a quant framework. I would, moving out of, let's say, the investing world today. What's happening? A lot of the decision making is data driven. Let's say if you're running, let's say, telecom business, where do you increase your revenue? How do you see lesser customer churn? All of that is now data driven. Earlier, at least for me, like, I was of this mindset that if someone doesn't understand, let's try and explain to them what the product is. But lately I've realized that some people who don't understand this, no matter what you do, they're not going to understand this because they've not experienced this. My response generally to those people is, maybe quant is not for you and you should not think of it as an option.
Okay, thank you so much, Gaurav and Rishabh, for those thoughts. Time for our next segment, which is Scroll Check, where we've pulled out some posts from the social media and I'll be reading out for your reactions. So the first one is just finished backtesting my momentum strategy on Nifty 50 options. 83% annual return, max drawdown 12%, sharp ratio of 3.8. Running it for 8 years of data, deploying 25 lakhs on Monday, already thinking about quitting my job in 6 months. Algo trading is the future.
I think I relate to this, because I used to do these kind of things in the past, and I used to think that, okay, fine, I would run a backtest, I would have a successful system. Once I had a successful system, I would go back thinking I'm very rich, without actually deploying the capital. But when you deploy the capital, that's when you realize things like slippage, and, you'll have that learning experience. So I am for deployment of capital and taking risk and learning from those mistakes, but you should you should go into this with lots of doubt also. Don't go in with so much certainty that like you're going to multiply money at that rate. Go with a lot of doubt that, listen, like if the backtest is showing something like a 78% or 70-80% kind of a return, I need to question, why is that happening, where is it coming from. So it's great to be positive, but at the same time you should have that balance in your mind, I think, so that, okay, fine, where are the cons of the system, what's wrong over here. Don't just think that I'll quit my job and this is going to be the future, because you're going to go through all those pitfalls. Yeah.
Next one is ran 500 parameter combinations for my RSI plus MACD plus Bollinger Band strategy on Bank Nifty. Found a perfect setup. RSI 14 crosses 63.5 MACD, 821.5 BB squeeze at 1.8 ST. Backtest shows 45% CAGR for over 5 years with max drawdown of 15%, deploying tomorrow.
I mean, this is like almost like a no-brainer. That is what you've done, is that you've just taken data points and said, it's like buying at the low and then selling at the high and saying that, oh, I bought the Nifty at 8,000, I sold it at 24,000, and I that's how my system's identified. Obviously, out of 500 optimize or 500 different parameters, something is going to do really well. So this is a clear case of overfitting. It's like a no-brainer. This is like extremely first level, wherein you've just started backtesting and you think that you have the answer out there. Not to say that we haven't experienced this, we've experienced this ourselves also, but
That's how you learn.
yeah, that's how you learn.
Yeah, I think the biggest red flag in the tweet that you read out is I found a perfect strategy. Now after having run through so many exercises, like we understand that there's no perfect strategy or ideal strategy that exists. There are obviously some benefits with some strategy. With those strategies, you also see some things that don't work out for you. I don't think at this moment as I speak there's a perfect strategy that exists.
Unless Claude comes out with thank you, guys. I think it's time for our next segment, which is answering the internet. We've received some DMs and people want your answers on those questions. So let me read out the first one. I keep seeing quant PMS firms showing 30-40% CAGR in their backtested strategies. Should I trust these?
I think so. I mean, everything is, needs to be questioned. It could be true, it could not be true. There is no question on another firm, but the idea is that from an investing principle, like if you're an investor, what you want to understand is challenge the process, understand, even if the backtest is true, understand that, what does the backtest entail, what kind of assets are there, go through it trade by trade, because you're putting in your hard-earned money out there, right? So the idea is that, like, you got to question that how the return has come. Just don't go based on the number. And I think this applies to other places also, even like when you're investing in mutual funds. Just don't go, sort based on the top performing mutual fund and deploy funds out there, because the future is going to be very different from the past.
Next question is quant investing nothing but algo trading by another name?
So if you look at, we're looking at two segments of the market. One is quant investing, one is algo trading. If you look at the literal meaning of quant, it is derived from the word quantitative. And what does quantitative mean? It sort of means something that is mathematical, something that is scientific. There are rules involved. When you look at algo trading, what an algorithm, what does it is derived from the word algorithm. What does an algorithm mean? It sort of means that the entire process is automated. I think so. These are two different parts of an entire the market, right? So there could be a quantitative system that could be algorithmic, which is, you know, you automated your entire process and it's algorithmic. There could be a quantitative system which is not algorithmic, whereas, you know, wherein the execution and sort of the research is a manual process. So I think there is a distinction. Now the way the market, the general thought processes, if it's quant, then it's sort of lower churn. If it's algo, it's like high churn, and like, you know, it could be medium frequency, high frequency, etc. But I think this distinction needs to be made very clearly, that quantitative means that it's sort of a scientific process. There is no subjectivity involved. It's, you know, it's purely objective. Algo could apply to a quant model. It could not apply to a quant model. You could have, you know, a subjective process also, in which you're using an algorithm. To give you an example, say today you want to buy, you know, 100 crores of Reliance Industries. You could use an execution algorithm to buy that stock, right? So, you know, all you have to do is that put in that I need to buy so much, and the algorithm will automatically decide volumes, when to buy, what price to buy it, etc. So, you know, this is the broad distinction between quant and algorithms.
Okay, thank you so much, guys, for that lovely discussion and the answers. I think they were really interesting.
Thanks, Pratik. Thanks for having us.
Thank you, guys. Really exciting conversation, and learned a lot from this. If this made you think twice about the next backtest someone shows you, please consider subscribing. And for more market related insights, hop on to our newsletter